Welcome back to HDIN Research. Today we're looking at a titan that's currently bleeding for its future. ZEISS Meditec just released their annual numbers, and it's a classic case of winning the battle but losing the wallet. Revenue is growing, yet their profit just took a 21% nosedive. Is the world's most famous lens maker losing its focus? Or is this the smartest billion-dollar gamble in medical history? Let's peel back the layers. ZEISS has what we call golden handcuffs. They are the undisputed kings of the operating room. If you're having neurosurgery, there's a 50-50 chance a ZEISS microscope is looking into your brain. But here's the catch. They've historically relied on selling these multi-million-dollar quote big boxes. When interest rates go up, hospitals stop buying. It's like trying to sell Ferraris during a gas crisis. So why the profit slump? It's a triple threat. First, they borrowed 400 million euros to buy their biggest rival, and the interest is eating them alive. Second, the US-China trade war hit them with a 30% tariff tax. Imagine every part you buy suddenly costs a third more. Combine that with massive integration costs, and you've got a hole in the pocket the size of a crater. But here's the counterintuitive part. While the headlines scream loss, the internal engine is getting stronger. For the first time, half of their money is now recurring. They've successfully moved to the razor and blade model. They sell you the laser once, but you pay them for every single eye you fix. It's like Netflix, but for eye surgery. In the world of laser eye surgery, ZEISS's SmileTech isn't just a product. It's the dictionary definition of the procedure. Despite the global chaos, this segment grew over 8%. Why? Because even in a recession, people still want to see. They've built a moat so deep that competitors are still struggling to swim across it. While eyes are the growth engine, microsurgery is the cash cow. With a 14% margin, this is where the real profit lives. They aren't just making microscopes anymore, they're building robots with 4K 3D monitors. They've taken the high ground, and even with Leica and Olympus nipping at their heels, ZEISS is still the boss of the brain. To fix their hardware problem, ZEISS dropped over €1 billion to buy DORC. Think of it as the ultimate missing puzzle piece. DORC makes the high-frequency liquids and tools used inside the eye. Now, ZEISS doesn't just provide the light to see, they provide every single tool the surgeon touches during the procedure. It's total vertical integration. Here is the wow factor. ZEISS is building the Apple ecosystem of healthcare. Once a hospital connects all their patient data into ZEISS workflows, they are locked in. Switching to a competitor would be like an iPhone user trying to move everything to a flip phone. It's not just about lenses, it's about who owns the data. China is ZEISS's biggest headache and biggest opportunity. Nearly 45% of their sales come from APAC, but the Chinese government is forcing volume-based procurement. Translation? They are forcing prices down by 50%. ZEISS is responding by running away from the cheap stuff and focusing only on the ultra-premium private clinics. To survive the trade wars, ZEISS is playing chameleon. Their strategy? In China for China. They are building factories in Suzhou and Guangzhou to make localized versions of their tech. This isn't just to save money, it's to make sure that even if a full-scale trade war breaks out, ZEISS is already, local enough to stay on the shelves. Every giant has an Achilles heel. For ZEISS, it's the 4 horsemen of risk: geopolitics, high interest on their debt, currency swings, and new EU regulations that add millions in costs. If the US and EU escalate their trade spat, ZEISS could lose 15% of their earnings overnight. They are walking a tightrope over a very windy canyon. Don't count them out just yet. Despite the profit dip, their house is made of stone. They have an equity ratio of 62%, that's incredibly high for a tech firm. They aren't begging banks for money, they are funding this entire billion-dollar transformation with their own spare change. In consulting terms, this is a fortress balance sheet. Innovation is the only way out. ZEISS holds over 1,000 patent families. They are shifting their R&D away from just, glass and towards robotic surgery and SaaS. Imagine a world where the AI detects your eye disease before the doctor even walks in the room. That's the 2026 goal, moving from a lens maker to an AI diagnostician. So what's the verdict? 2024 was the year of pain. 2025 will be the year of integration. And 2026? That's when the rocket ships. They expect to return to those juicy 20% margins by then. They've laid the foundation, paid the debt, and built the ecosystem. Now, they just need to execute. The pain of today is truly the foundation of tomorrow. If you found this breakdown valuable, you can find the full-page, deep dive report on our website. At HDIN Research, we don't just look at numbers. We look at the strategy that drives them. For custom consulting or market reports, reach out to us at sales@hdinresearch.com. Thanks for watching, and stay sharp.